Hey there! Welcome back to Legend Finance, the place where we all explore personal finance together. If we're not already connected, let's change that now. Hit subscribe and ring that notification bell so we never miss an opportunity to learn together. Today, we're jumping into a fascinating topic that's got everyone talking: mortgages and how we can tackle them faster using a tool called HELOC. It sounds like a term from outer space, but once we get the hang of it, it can be a major catalyst for our collective financial freedom. So, some of you might be wondering, what is this HELOC? HELOC stands for Home Equity Line of Credit. It's a type of loan that lets us borrow against the equity we've built up in our homes. Think of it as a credit card for the house. When used responsibly, it can be a big step towards clearing our mortgage early. Of course, there are questions. How does this all work? Is this really a smart move? What risks are involved? And the big one, how can it help us? We'll be addressing these questions and more in today's video, so stay tuned, grab a notepad if you'd like, and let's navigate this financial maze together. Are we ready to potentially cut years off our mortgages? Let's make it happen. All right, let's get into it. HELOC, or as it's fully known, Home Equity Line of Credit, is what we're discussing today. Now, the simplest way to describe a HELOC is to compare it to a credit card, with the difference being that your home's equity serves as its security instead of your credit score. So, if we're scratching our heads wondering what equity is, don't worry. It's quite simple. It's essentially the value of your home, or rather, the fair market value, minus any debt attached to the property. When we're talking about a HELOC, we're taking that equity and turning it into a line of credit. Imagine having, say, $100,000 on a credit card that could be used for all sorts of things. But here's an important consensus. While we can all agree that having that much credit can be tempting, using a home equity line of credit to splurge on luxury items like a new boat or a vacation home should not be on our agenda. We need to be smart and responsible about how we use our HELOC, and we'll talk more about that as we continue this journey together. So here's the deal, folks. We all know that if we play our cards right, a home line of credit can work wonders. Picture this. Using our HELOC, we might just manage to pay off our mortgages way earlier than planned, or even snag ourselves a rental property that's churning out income. Not too shabby, right? Now, this is where things get interesting. As we keep chatting today, we're going to take a close look at HELOCs and traditional mortgages, compare them, and dig into why some of us might actually lean towards a HELOC. So stay with us. It's going to be a ride full of insights and light bulb moments. You know what's really cool about HELOCs? They're open-ended, just like our conversations here. Picture your credit card. You use it, you pay it off, and then you can use it again. That's exactly how a HELOC works. Use it, pay it back, and voila, it's ready to be used again. And here's another sweet thing about HELOCs. They use simple interest calculations. If you've ever tried to make sense of a mortgage amortization calculator, you'll appreciate this big time. But hey, this isn't magic. How well it works out depends entirely on how we use our HELOCs. Let's be real. If we don't handle it the right way, we could find ourselves back at square one, like we're dealing with a traditional mortgage. But if we play our cards right and follow the tips we'll be discussing here today, we'll likely navigate the whole process without a hitch. So buckle up, friends. We're about to delve deeper into this. All right, let's dive into this a bit more. One of the top perks of a HELOC, which we all love, is that it uses simple interest calculations. And because it's open-ended, meaning it can be used, paid off, and used again multiple times, we're going to see a lot more transactions happen. Now, the bank is pretty clever. It uses something called an average daily interest calculation. Sounds complex? It's not. They simply take your interest rate, divide it by the number of days in a year, that's 365, and then multiply it by the balance of that specific day. On the other hand, if we're not tossing any extra payments into the mix, a mortgage can feel a bit more rigid. But that's why we're here, right? To explore these different options and figure out what works best for us. So let's keep the conversation going. When it comes to a typical mortgage, things are fairly straightforward. As long as we're keeping up with the scheduled monthly payments, the system simply calculates the interest based on that month's balance, and voila, that becomes our interest payment. A HELOC, on the other hand, is a bit more meticulous. Instead of a once-a-month check-in, it evaluates the situation daily. But remember, if we start managing our HELOC as though it were a regular mortgage, it's going to start behaving like one. The balance recorded each day will dictate the calculations. And this is where the day-to-day details of a HELOC really come into play. Let's imagine we have a $10,000 balance in our HELOC today. Then, by tomorrow, we will manage to reduce it to $9,500. The interesting thing with a HELOC is that we'll be charged different amounts of interest for today and tomorrow simply because our balances were different on these 2 days. It's that responsive. A HELOC is open-ended and uses simple interest calculations. It's flexible and lets us re-borrow the money we've paid back, giving us the freedom to manage our finances more fluidly. Contrast this with a traditional mortgage, which is closed-ended. Once we've made a payment towards it, that money's gone. We can't borrow it back unless we go through a refinance. Plus, it uses an amortized interest calculation, where it considers the balance for the whole month to determine the interest due. Mortgages usually come with what's known as an amortization schedule, laying out a clear time frame, often 15 or 30 years, to reach that glorious moment of hitting a zero balance. On the other hand, with a HELOC, we get more control and can potentially get to zero faster. And that's the beauty of understanding these different financial tools. We can make them work for us. And here comes another compelling reason why many of us are fans of using a HELOC to whittle down our mortgages. There are a couple of strategies we can explore, and we'll be sharing 2 variations of those at the end of this video, so stick around. Sure, the chunking strategy, often also referred to as the mortgage acceleration or HELOC, home equity line of credit method, is a debt reduction strategy aimed at paying off a mortgage faster using a home equity line of credit. Here's a summary of how it works. 1. Establish a home equity line of credit, HELOC. This is a type of loan that uses your home as collateral. It's similar to a credit card in that it's a revolving line of credit, which allows you to borrow up to a certain limit, pay it back, and then borrow again. 2. Transfer a chunk of your mortgage to the HELOC. The chunking strategy begins with you moving a portion, or chunk, of your mortgage balance into the HELOC. This reduces the principal amount of your mortgage, which in turn reduces the amount of interest you pay on the mortgage over time. 3. Pay down the HELOC balance. You then focus on paying off the balance on your HELOC as quickly as possible. This can be done by funneling all income and disposable cash towards the HELOC debt. During this period, it's essential to minimize expenses to the absolute minimum necessary to speed up the repayment process. 4. Repeat the process. Once the HELOC balance is paid off, you repeat the process, moving another chunk of your mortgage into the HELOC and then aggressively paying it down again. This cycle continues until your mortgage is completely paid off. This chunking method we've been talking about is built on the idea that since HELOCs use simple interest and mortgages are all about compounded interest, we can cut down on interest over time if we use a HELOC wisely. But let's not forget that the success of this strategy relies heavily on our ability to budget responsibly, trim down expenses, and of course have a steady and reliable income stream. It's also key for us to understand the nitty-gritty details and possible risks of our specific HELOC. Some might come with variable interest rates or other fees tucked away in the fine print. Remember, it's always a good idea to chat with a financial advisor before trying out a new strategy like this. They can provide some tailored advice and make sure we're on the right track. So we've got options, and that's a good thing. But let's also make sure we've got all our bases covered. In addition to the chunking strategy for paying off a mortgage early using a HELOC, another commonly referenced strategy is often called the sweep strategy or cash flow strategy. This strategy also utilizes a HELOC, but in a slightly different way. 1. Establish a home equity line of credit, HELOC. Just like with the chunking strategy, you first need to establish a home equity line of credit using your home as collateral. 2. Transfer income to the HELOC. In this strategy, instead of transferring a portion of your mortgage to the HELOC, you deposit your entire paycheck into the HELOC each month. 3. Use HELOC for expenses. You then use the HELOC to pay all your monthly expenses, including your mortgage. The idea here is that because you've deposited your income into the HELOC, you'll reduce the balance temporarily, which reduces the interest you owe because interest on a HELOC is calculated on the daily balance. 4. Pay down the HELOC. Over time, as you pay your expenses from the HELOC, the balance will rise again, but the goal is to ensure that over the course of the month, the average balance is lower than it would be if you didn't deposit your income into the HELOC. 5. Repeat the process. This process is repeated every month with the aim of paying less interest over the life of the mortgage. In summary, we want to provide to you the pros and cons of using a HELOC. Pros. 1. Access to cash. It's a great way to access a large chunk of cash for big expenses, like home improvements or college tuition. 2. Lower interest rates. Typically, the rates are lower than credit cards or personal loans. 3. Tax deductions. You may be able to deduct interest if you use the money for home improvements. Cons. 1. Risk of losing home. Since you're using your home as collateral, if you can't pay it back, you might lose your house. That's pretty scary. 2. Fees. There could be upfront costs or annual fees. These can add up. 3. Variable interest rates. Rates often change over time, which can increase your payments unexpectedly. So make sure to weigh these pros and cons and your ability to pay back the loan before making a decision. And that's a wrap, folks. We've just demystified the concept of using a home equity line of credit or HELOC to pay off your mortgage earlier. We hope you're now feeling more empowered and informed about this financial strategy. Remember, here at Legend Finance, we're all about helping you navigate the financial seas with confidence, whether it's understanding complex financial concepts or providing practical tips and tricks to help you achieve your financial goals. If you found this video helpful, don't forget to hit that like button and share it with your friends and family. They might just thank you for it. And if you haven't already, subscribe to our channel and click the bell icon to stay updated with the latest in the world of finance. Got any questions or topics you'd like us to cover in future videos? Drop us a comment below. We love hearing from our Legend Finance community. Until next time, keep investing in your financial knowledge. And remember, you're not just building wealth, you're building your own legend. This is Legend Finance, signing off. Stay legendary.